Good morning, everyone. This is Pauline Chung from the San Mateo Area Chamber of Commerce. Thank you for joining us today for our Business Essentials program. This is our professional education series that we hold 1, 2, or 3 times a week at 10 a.m. in the morning. Today we have longtime chamber member Ray Avanzino. He's branch manager for Stearns Lending, 18 years in the mortgage industry. So he will be talking about everything you want to know about buying or refinancing a home during the pandemic. I do ask that you stay muted during Ray's presentation. We would address questions at the end. And take it away, Ray. Thank you.
Okay, thank you, Pauline. I really appreciate the opportunity. And yeah, the Chamber's been fantastic. Been a member for, gosh, almost 20 years. And it's a great way to get out and meet people. So I'm with Stearns Lending. I've been with them for about 18 years. With them about 5 years, but in the mortgage industry for about 18. I was born in San Francisco and been living on the peninsula now ever since. So local guy in California here. I'm going to start the presentation off. So basically you see here COVID-19 in the mortgage market, strong history, bold future. This is a slogan we use for recruiting. And really it holds true with Stearns itself. They've been around for 30 years and, you see the ups and downs, but, we always seem to come back. And of course, this whole COVID thing, pandemic is one of those challenges we're going through right now. We all started the shelter in place roughly about mid-March and, we're getting through it all. And just like all the other industries out there, financial, real estate, small business and so forth, we all have a strong history and we got a bold future. So we're looking forward to second half of the year. First half was challenging and we'll see what the second half holds true. So I'm going to move ahead here to the breakdown here of what we're going to talk about today. So this is what's happening, some of the discussion topics that we're going to go through, talk about lender guidelines and how they've changed a bit since the COVID, product options, products that have come in and out since mid-March, some of the high-risk industries out there that the lenders have to look at a little bit closer now due to the COVID, forbearance, big topic, appraisals, how they're being treated now, and escrow signings and closings. So just gives you sort of a breakdown of what we're going to go over here in the next 20 minutes or so. And everything we talk about, it's challenging, of course, markets, but the market is really hot. Lenders are still lending. Guidelines have changed. Some products are not being offered, but it's a really hot market right now. Interest rates are at all-time lows. And it's really on the refinance side, it's shaping up to be, one of the hottest markets in history. We're projected to see 100% increase in refinancing this year, which is just incredible. And the purchase market was off to a little slow start at the beginning here, March, April, but it's really coming back here, May, June, July, the second half, looking to see some big increases, in the, on the purchase side. And, we still have on the real estate side, we have limited supply of homes and we have an abundance of buyers. So we're still seeing prices remain steady, if not climb slightly. There was a house on our street on the market, was put on right before July in Belmont here. And it's pending right after the 4th of July. So things are moving quickly still, and we're looking forward to a strong second half. So all positives, hopefully, for the future here. So as we move forward, we'll start to get into this. We'll talk a little about lender guidelines. So I have in my hand a handout. I don't know if you can see it. Maybe with my green screen you can't. But anyway, I have 38 pages of lender guideline changes. Maybe if I go like that. Lender guideline changes that we get an update every week on some of the all the changes that have gone on with the programs out there, from conforming to FHA to jumbo to bond loans. So things have been changing ever since March 15th. And This is a screenshot, the first page of just some of the changes that are going. I'll just focus on a few of them. And one of the examples would be LTV, we call it loan to value. So what they've done is decrease loan to value. So in other words, if you're buying a home, in some cases, you have to put more money down. For instance, if it's a non-owner occupied investment property, you've been able to put 20% down in the past to buy. Now that's been increased to 25%. So you'll see a lot of changes between 5 and 10%. So they're just trying to level the risk level due to the whole pandemic and so forth. In other areas, for refinance, say for an investment property, they want you to have 70% equity. So in other words, 70% loan to value if you try to do a refinance instead of say 75%. So that's a change. And there's a lot of other changes in loan to value, depending on the type of loan, like some lenders on the jumbo side. And when we talk about conforming versus jumbo, there's basically 3 levels of loans. You know, you have conforming, which is loans up to $510,400. And then there's the conforming high balance, which goes from the 510 up to $765,600. And then anything beyond that level is the jumbo. Okay, so that's when I'm referencing those categories that relates to those loan amounts. So another area that's changed a lot across the board is DTI, we call it debt to income. And that's basically, what it says, debt over income, how we approve a loan. And typically in the past for say conforming loans, we were able to go up to 49.9 to get an approval on a conforming loan amount. Well, they've lowered that down to 45. So, again, there's almost a 5% change. And sometimes when we're talking about this, it doesn't seem like a lot, but it could be a matter of someone getting a refinance approved and or a purchase, or also relate to how much their buying power would be. So all these numbers do come into play and make a difference, So that's debt to income, and that's been affected across the board on all types of loans. Credit scores. What a lot of lenders are doing right now is they're requiring higher credit scores than what they had before the pandemic. So one example would be FHA loans, first-time home buyer loans. We in the past were able to go down to 580 credit score. Now they've upped it to 620. So when we look at credit scores, right, we run, the lenders run 3 credit scores from the bureaus, and then we use the mid scores. That's how we lend. We base the credit score on the mid score. Someone may go online and say, Credit Karma said my credit score was 720. Well, that may not relate to what we see, because when we run credit, there's a little more riskier parameters tied into it. So the numbers may not reflect everything that you see online. But anyway, so credit scores are affected. In other words, they're wanting higher credit scores for various loan products. Another area is cash out. When someone does a refinance, you could do a refinance rate and term, which is no cash out, or you could do a cash out refinance, where you're taking cash out to pay off debt or home improvement or whatever. So in those situations, there's been limitations on the amount of cash out that you could take. Initially, when COVID started, or the pandemic in mid-March, well, at least when we were put in shelter in place, I guess it started last year, but anyway, they started restricting cash out much more on the conforming and conventional loans. Now, recently they lifted that. Now, we don't know if that's going to go back, who knows, but they lifted the limitations on cash out so that they opened it up actually. But when it comes to jumbo, and I'll talk about that later, there still is some restrictions on cash out, and I'll get into that a little bit later. So that's the guidelines, and again, there's 35 pages, and of course, you don't want me to go through all of that, but it's a big issue. Things are happening, but we have to follow. What may have been true in January is not true now, so you have to really follow closely. Next area we'll talk about is product availability. Same thing with guidelines. Some products either are not available now or have been tightened up a little bit more. For instance, jumbo loans. In the past, it used to be a lot of lenders would offer the 80-10-10, we would call it. So in other words, if you're looking to buy a home, and some people may be making a lot of money, but they don't have a lot of money for the down payment. So they maybe just have 10% down. So that we call as an 80-10-10. You have an 80% first loan and a 10% second or equity line. Well, the two equity line companies that we were working with, they actually suspended operation. I mean, they're probably going to go back to offering equity lines, but right now they're on a pause. So, and a lot of other lenders out there, banks and so forth, aren't offering the 80-10-10. In other words, up to 89.99% loan to value. So that's, in most cases, has gone away. There may be one or two out there, or there may be a couple out there that are still doing it. And that's where I can come in play, where I can go out there, because I'm a direct lender with Stearns, I'm also a broker, so I can go out there and look for whatever potential loans may be available for you. So also with the jumbo, a lot of the banks are not offering interest only anymore, you know, an interest only mortgage. And then some have even stopped lending on investment properties. And this is tied mainly to jumbo, okay? Because on the conforming and the high balance, right, the lower loan limits, you could still lend in those areas. And, but some banks and direct lenders and mortgage brokers are not offering the, some of these other products on the jumbo side. Bond programs, those are offered throughout California, you know, where you can get actually on the conforming and high balance loan amounts, you can get a first, second, and third, and basically come in with very minimal amount to buy a home. And some of those programs were suspended in the beginning. Now they're starting to come back. So that's going back and forth. Alt-A lending, which is alternative lending. Those are companies that offer, you know, you got the prime lending, then you got Alt-A, which is another level of lending. When the COVID came out, the shelter in place, a lot of companies actually stopped operation for like 30 days to reevaluate what's going on. Now, some of them have come back into play, some have not. So there's just a restriction on some programs offered. We talked a little bit about cash out already, restrictions. Oh, what I wanted to mention was one of the major banks just announced, I think it was this week. And the thing is, the lenders are very busy. So what they are starting to do is restrict potential of maybe new loans. Like in other words, if you're working with a certain bank and you're coming from the outside, in other words, you don't bank with them, they may throw on additional restrictions because they're so busy. So one of the major banks has said if you are not banking with them right now on a jumbo cash out refinance, you need to bring in $1 million to their bank in either investments or cash or whatever, in order for them to consider a jumbo cash out refi. So that's pretty major. I mean, it was 250,000. The increase is to 1 million. So they're really shutting the spigot off in that sense. So a lot of different things going on there. You just have to be aware and try to adjust to it. The investment properties we talked about, where they increase. So that the keys that got hit the most, I think, when you look at the industry as a whole, is investment properties and jumbo loans. They are definitely still available, but there is just more limitations. We talked a little about the FHA already. One thing about FHA, first time home buyer, if you know anyone, it's 3.5% down. Now, again, the loan amount cannot go over $765,600, but they can put as low as 3.5% down, and we can go up to 55% debt to income. So that gives us a lot of leeway where, excuse me, conforming loans, right, they go up to 45%. So you get an additional 10%. And I had someone just yesterday or earlier this week where we're looking to qualify, and we need that extra 5% or 6-7%. So they're qualifying at like at 51% debt to income. So a lot of opportunities there on the FHA side. And you see more of that across the Bay because of the price points. On the peninsula, you know, most of your average price 1.5 or higher, 1.5 million or higher, wouldn't come into play with an FHA loan. You're looking at more of the jumbo loans. So that's product availability. High risk industries. So you can see how this would come into play when you look at this. And what it really means is that it's not that we're not lending within these industries, it's just that we're taking a closer look at them because they've been hit so hard by the pandemic. And you can sort of understand, if you're out there, travel, hit hard, tourism, people aren't really taking vacations. Same with leisure, hospitality. They sort of all tie together: travel, tourism, leisure, hospitality. I had a person from the very beginning, and actually it was the only loan that we had to turn down in the beginning of late March, and it was tied into self-employment and higher loan to value, and they wanted some cash out. And in the end, because they fell into one of these industries, they actually backed off the loan. But again, we're still lending on them, but it's just there's a little more scrutiny. Restaurants, you can understand that. Some restaurants, they had 20 employees, they're down to 5. So there's a lot of different things going on there. And you can understand, unemployment right now is a little over 11%. There's about 17.8 million people on unemployment. And when it comes to getting furloughed, and this is of course in any industry, that you need to have returned to work and have gotten a pay stub to be able to get a loan. Because some people, say, well, I was furloughed and I'm going to go back to work, end of August. Well, we can't lend until we know you're back to work and, that there's pay stubs and there shows a history of getting that income that you used to get. And also I get asked this a lot. If people are put on unemployment, if you're on unemployment, borrowers cannot use that to qualify for buying, because that's a temporary situation. In other words, you're not working, you're on unemployment, you're getting money, but you must be back to work to qualify. And also when they look at all these industries too, and we'll talk about this next, is forbearance. There's over 4 million loans right now that are in forbearance. And that's 8% of all loans out there, which typically the average for forbearance in the industry is 2 to 3%. So you can see it's, pretty much tripled in regards to the whole forbearance thing. So anyway, these top 10 categories, we are still lending, but we're just giving a closer look at the industry and the consistency of income and so forth. So just something to think about. And when we go in and pre-approve people, there's all the different questions, of course, we're asking up front, how have you been affected by COVID? Are you still working full time? And we had a situation where the person was, they were furloughed, and we had to hold off till we got to wait a couple months to get them back in employment before we can actually help them with a refinance. Okay, moving swiftly along, mortgage forbearance, huge topic. And I think a lot of you heard about this. Forbearance, excuse me, allows the borrower to skip a mortgage payment or make a smaller payment. And then recently enacted the CARES Act, the Coronavirus Aid, Relief, and Economic Act, includes forbearance options due to COVID-19. And the types of forbearance will depend on the type of mortgage. For instance, federally based mortgages, FHA, VA, USD, and even conforming, you can go up to 12 months without paying. Now, the one thing you got to really think about this is that what we found is a lot of people, when this COVID first came out, the whole idea of the shelter in place, and this act came out, a lot of people just went on the forbearance just in case, and not really the best thing to do. If you could pay your mortgage, because there can be factors involved. In other words, we had a couple that we had gotten into a refinance, and then as we looked at their mortgage statement and so forth, gathered the paperwork, we realized that they were in forbearance. They went into it just in case. And so we had to tell them, look, you either need to pay it up or we have to wait. So he went ahead and just paid it up. He was just a month and a half behind, but he got paid up, and then we were able to run it through underwriting and we were able to get it done. So the thing is, the key factor here is that if you're in forbearance, in most cases, a lender will not lend. You know what I mean? You can't buy or you can't refinance because if you think about it, a lender, you're with another lender and you're not paying that mortgage. So something's up, you know what I mean? So you want to really think about that. You don't want to just jump into forbearance just in case you want to. If you have to do it, then you got to do it. But if you don't do it, because it may affect you on the back end. And part of this act was it won't affect your credit score at all. You want to really follow that to make sure that the lenders are following suit on that. Some lenders, maybe on the jumbo side, after the forbearance is up 3 to 4 months, they may have you get caught up on those 3 to 4 months in one lump sum. I mean, that's a big hit, which could affect, you may not be able to handle that. Or they may modify your loan, where they put it on the back end of your loan, whatever amounts you haven't paid, and then they put it on the back end of your loan amount, and then sometimes analyze your actual monthly mortgage payment. But then again, if your loan was modified, you may have issues with getting a refinance and purchase down the road. And there's a great website there to follow, consumerfinance.gov. You can see it there on the screen. And check that out. It's a pretty cool website, got a lot of good information. Okay, so that's mortgage forbearance. Moving along, I think we're doing okay on time. It's 10:25. Just a couple more topics here. Appraisals. Appraisals have changed a lot. In the past, when you had an appraisal, right? So when your home gets appraised, the appraiser goes out there and they always do an internal and external appraisal. They go inside, they take photos, they take measurements, they make sure your water heater is double strapped, they make sure you have a a CO detector installed. And any health and safety issues. You have to make sure there's no holes in the walls or floors or whatever. But what they're doing now with COVID is that if it's a rate and term refinance, in other words, no cash out, and I've had this done many times in the last 3 months, and if the loan's owned by Fannie or Freddie, Fannie Mae, Freddie Mac, we looked that up, the address up, and if it's owned by them, they could just do a drive-by appraisal, we call it, right? So they don't have to enter the home, which is great. A lot of people don't want anyone to be in their home. So all they do is they drive by, they park, they take some photos, and then they complete the appraisal with all the online information. So that's a great way with the drive-by. With purchases and jumbo and cash out, in most cases you need full appraisals. So they do have to stop and go in the house. And most people are open to that. I mean, everyone knows now, you got to wear the mask, you got to wear the gloves, you got to wear the booties, you got to be careful. You don't want to touch things if you don't need to touch things and so forth. So you got to be safe. So that's appraisals. They've changed. And really when it comes to the drive-bys for rate and term refinances, I mean, that's the best thing going because all they do is they stop, they take photos and they're gone. So that's for appraisals. Closings, we're almost done here. Closings, title companies. Now with most of the title companies, they may be open, but they're not having in-office signings. So really, in most cases, you got a mobile notary, which is very popular. And the mobile notary comes to their home or you meet somewhere. Like yesterday, we had a purchase signing. We met at my company's cafeteria because it's a huge room. It's funny, not funny, but there's no chairs. They take all the chairs out now. I don't know if you notice this in some of the big companies or if you've gone to different places because they don't want people sitting down. So anyway, we stood up and had a tall table and we did the signing. Everyone had masks and gloves and all that. So mostly now with signing, it's all mobile notaries and recordings, same sort of thing. Most of the county recorder offices are not open, so that's all done with e-signing. So, thank God for the internet and like we're doing right now, we wouldn't all be connecting so much. So that's a great thing. And really, this is just a quick summary of Stearns and what we offer. I mean, I know you have a lot of choices out there. Stearns has been around for 30 years, Stearns Lending. We have 100 offices throughout the U.S. We've been ranked, fairly high with the various agencies and so forth. So if I could ever help with any questions or, let me know. I'm here. I'm in San Mateo, Belmont, and you can reach me, via email, cell phone. And that's really it. If Pauline, if there's any questions, I'm here.
Yeah, we do have a question from Amy Cook. Says,
Amy.
yeah, I read that lenders are shying away from jumbo loans because only conventional loans are being purchased in the secondary market. How is this affecting jumbo rates?
Good question. Yeah, so definitely jumbo has been hit pretty hard, but there still is big demand, so the rates are still good. In fact, that's one thing I didn't mention at the end here. I wanted to close with a few rate quotes. So it's a good point, Amy, but yeah. And when I was talking about jumbo, there is a lot of restrictions now, like there's cash out restrictions. In fact, some jumbo lenders are not offering cash out refis. Some of them aren't offering interest only loans. Some of them aren't offering investment purchase loans. Some of them aren't offering that 80-10-10, that piggyback 10% down loans. So a lot of restrictions, but they're still lending. And really rates on conforming, I mean, a jumbo 30-year, about 3.25, could be even 3.125. That's on a 30-year. So really great rates on jumbo. And then the 10-year ARMs, which is another good choice on a jumbo, that's below 3%. Could be 2.625 to 2.875. So incredible rates. FHA loans, which is the first time home buyer, those rates are like in the mid twos, 2.5, 2.625. Incredible. And conforming rates are below 3%. I just locked one yesterday for 2.99 with some credit towards closing costs. And so yeah, incredible rates. And yeah, jumbos are still out there. There is restrictions, but the rates are still remaining low because of the demand for the jumbo product.